Most traders don't fail because trading is complex. They fail because they make it complex. Think about that for a moment. You've probably been told that success in the markets requires more indicators, more strategies, more information. But if that were true, wouldn't the most successful traders be the most complicated thinkers? And yet, time and again, the traders who endure, the ones who last, are often the simplest in their approach. So let me ask you, are you trading the market, or are you wrestling with your own ideas about it? Watch how most people trade. They jump from one setup to another. One week it's breakouts, the next it's mean reversion. They add indicators, then remove them, then replace them again. Their charts become crowded, but their decisions become less clear, and when a trade fails, what do? They don't simplify. They add something new. Why? Because complexity feels like control. But look closer. Every added rule, every extra signal, it doesn't reduce uncertainty. It disguises it. And in that disguise, traders begin to hesitate. Have you ever noticed how the more rules you try to follow, the harder it becomes to actually act? Here's the truth: most traders overlook markets reward clarity, not cleverness. Simple rules work because they remove noise from your decision-making. They force you to focus on what actually matters: price, behavior, timing, and risk. But simplicity is uncomfortable. Why? Because it leaves you exposed. When your system is simple, there's nothing to hide behind. No extra indicator to blame. No complex model to justify a bad decision. It becomes clear. Your results reflect your discipline. And that's where most traders struggle. So let me ask you, do you complicate your system to improve your trading, or to protect your ego? Because those are very different motives. If your rules are simple, your decisions become faster. If your decisions are faster, you hesitate less. If you hesitate less, you execute better. And when execution improves, something subtle begins to change. You stop fighting the market. You start responding to it. Cause and effect. Always. But here's the part most people miss. Simple rules don't eliminate losses. They make losses easier to accept. Why? Because when your approach is clear, you know exactly why you took a trade and exactly why it failed. There's no confusion, no second guessing, just feedback. And feedback, when understood properly, becomes progress. So the question becomes, are you trying to avoid losses, or are you trying to understand them? Let's bring this down to the screen. A simple trader might look for three things: direction, level, and behavior. That's it. Direction: where is the market generally moving? Level: where are the key areas that matter? Behavior: how is price reacting at those areas? Now compare that to a cluttered approach. 5 indicators, multiple time frames, conflicting signals. One says buy, another says wait, a third says sell. What happens then? You freeze. Or worse, you act without conviction. So ask yourself, when you take a trade, do you know exactly why you're taking it? Or are you assembling reasons in the moment? Because that difference, that's everything. Let's go deeper. Simple rules also define what you don't do. Most traders focus on entries. Few focus on exclusion. But exclusion is where discipline is built. A simple rule might be, I only trade when price is aligned with the higher time frame trend. Sounds basic, doesn't it? But how often do traders break it? And when they do, what happens? They enter lower probability trades, experience inconsistent results, and then blame the system, not the violation. So let me ask you, do your rules guide your behavior, or do they bend to it? There's another layer to this. Simple rules create consistency, and consistency creates data. If your approach changes every week, what are you measuring? Nothing. But if you follow the same rules repeatedly, you begin to see patterns. Not just in the market, but in yourself. You start to notice when you rush, when you hesitate, when you overtrade, and that awareness, quiet, steady awareness, is what separates a reactive trader from a deliberate one. So consider this. Are your results inconsistent because the market is unpredictable, or because your behavior is? Let's talk about risk. A simple rule here might be, never risk more than a fixed percentage per trade. Again, nothing revolutionary. But simplicity has a hidden strength. It's enforceable. Complex risk models often look impressive, but under pressure they break. Simple rules, on the other hand, hold. Why? because they're easy to follow even when emotions rise, and emotions will rise. So the real question is, can your rules survive your worst moments? Now here's something subtle. Simple rules don't just improve your trading, they change your mindset. When your process is clear, you stop chasing outcomes. You stop needing every trade to work. Instead, you focus on execution. And when execution becomes the priority, something shifts. Pressure decreases. Clarity increases. And ironically, performance improves. But only if you trust the process. And trust doesn't come from complexity. It comes from repetition. So let me ask you, have you repeated your approach enough to trust it, or are you still searching for something better? Because that search, that endless refinement, it's often not progress. It's avoidance. Avoidance of commitment. Avoidance of responsibility. Avoidance of the uncomfortable truth that success in trading isn't about finding the perfect system. It's about following a simple one, without deviation. So where does that leave you? You don't need more strategies. You need fewer decisions. You don't need more indicators. You need clearer rules. And you don't need certainty. You need consistency. A clear rule is more powerful than a clever idea. It sounds almost too simple to matter, but think about how most traders operate. They are full of ideas, market theories, predictions, opinions about where price should go. The mind stays busy, constantly analyzing, constantly trying to outsmart the next move. But when the moment to act arrives, what happens? Hesitation. Why is that? Because ideas require interpretation, and interpretation takes time. In trading, time is often the difference between a clean execution and a missed opportunity. A clever idea might impress you, but it doesn't tell you exactly what to do when price reaches your level, when volatility spikes, or when a trade starts moving against you. A rule does. A rule removes the need to think in the moment. It defines action before emotion has a chance to interfere. If price does this, I do that. No debate, no adjustment based on how you feel, just execution. So ask yourself, when you're in a trade, are you following a rule, or are you managing an idea? Because the two behave very differently under pressure. Ideas are flexible, they bend, they adapt. And that might sound like a strength, but in trading, it often becomes a weakness. When a trade starts going wrong, an idea can justify staying longer than you should. It can convince you that the market is about to turn. It can keep you in a losing position simply because the logic still sounds reasonable in your head. A rule doesn't do that. A rule cuts through that noise. It doesn't care how convincing your reasoning feels. It only cares whether the condition has been met. And when it is, the decision is already made. Now consider the effect of that over time. If every trade you take is based on a clear rule, your results become measurable. You can track what works and what doesn't. You can refine your process with actual data, not assumptions. But if your trades are driven by ideas that change from moment to moment, what are you really learning? What are you improving? Consistency comes from clarity, and clarity comes from rules. But here's where it gets uncomfortable. A clear rule removes your ability to interfere. It limits your freedom in the moment. You don't get to feel out the trade or adjust based on intuition. You have to follow what you defined earlier when you were calm, objective, and not emotionally involved. So the real question becomes, do you trust your prepared decisions more than your reactive ones? Because that's what this comes down to. Most traders believe their strength is in their ability to analyze. But the market doesn't reward analysis alone. It rewards execution. And execution depends on clarity, not creativity. A clever idea might help you understand the market, but it won't carry you through a losing streak. It won't keep your risk controlled. It won't stop you from overtrading. A clear rule will. And when you begin to rely on rules instead of ideas, something shifts. You stop trying to be right on every trade. You start focusing on being consistent. You accept that not every setup will work, but every action will be aligned with your process. That alignment is where stability comes from. So next time you're about to take a trade, pause for a second and ask yourself, am I acting on a defined rule, or am I convincing myself with a good idea? Because in that moment, the difference between the two is not just subtle, it's decisive. If you can't explain your trade in one sentence, you shouldn't take it. That may sound restrictive, but it exposes something most traders avoid facing: lack of clarity. Think about what happens before you enter a trade. You scan charts, notice patterns, maybe check a few indicators, consider news, and then slowly build a case in your mind. It feels thorough. It feels intelligent. But when everything is layered together, do you actually have a clear reason, or just a collection of loosely connected thoughts? Because there's a difference. A single sentence forces precision. It forces you to strip away everything unnecessary and identify the real reason behind your action. Not 5 reasons. Not a vague feeling. One clear, direct statement. So ask yourself, right before you click buy or sell, can you say exactly why without hesitation? Something like, price is trending up, pulling back to support, and showing strength again. That's clear. It defines context, location, and behavior. It tells you what you see and why it matters. Now compare that to what most traders actually do. They think in fragments. It looks strong, maybe breaking out. RSI is okay, higher time frame looks bullish. None of it is wrong, but none of it is decisive either. And when your reasoning is scattered, your execution becomes uncertain. Have you ever entered a trade and then immediately felt unsure? Not because the market changed, but because your own reasoning wasn't solid to begin with. That's what happens when you can't compress your idea into one sentence. Clarity isn't just about understanding the market. It's about understanding your own decision. A single sentence acts like a filter. If your reasoning is weak, it won't hold together. If it's based on hope or assumption, it will sound vague even to you. And that discomfort, that moment where you realize you can't clearly explain your trade, is valuable. Because it stops you. It prevents impulsive decisions dressed up as analysis. Now consider the effect of this over time. If every trade you take is backed by a simple, clear sentence, your thinking becomes sharper. You start recognizing what truly matters and what doesn't. You stop overloading your charts. You stop chasing confirmations that only add confusion. Instead, you begin to see patterns in a cleaner way. You also create accountability. After the trade, you can revisit that sentence and ask, was the reasoning valid? Did the market behave as expected? Or did I misread something? Without that sentence, what are you reviewing? A feeling. A vague memory of what you thought at the time? That's not feedback. That's guesswork. Let me ask you something. When a trade fails, do you know exactly why it failed? Or do you just know that it didn't work? Because those are very different positions to be in. A clear sentence gives you something concrete to evaluate. It turns each trade into a data point, not just an emotional experience. But there's another layer to this. When your reasoning is simple, your mind stays calmer during the trade. You're not juggling multiple conflicting ideas. You're not constantly reinterpreting the situation. You know why you're in, and you know what would invalidate that reason. And that reduces noise. It reduces the urge to interfere. It keeps you aligned with your plan. Now imagine the opposite. You enter a trade with a mix of signals and assumptions. Price moves slightly against you. One indicator shifts. Another still supports your bias. Now you're stuck. Should you hold or exit? You start thinking more. You start doubting. And that doubt doesn't come from the market. It comes from your lack of clarity at the start. So again, the question is simple. Can you explain your trade in one clean sentence? Or are you building a story around it? Because the market doesn't respond to stories. It responds to conditions. Most mistakes come from breaking rules, not lacking them. Traders often believe their problem is knowledge. They think they need a better strategy, a sharper entry, a more refined system. But if you look closely at their trades, the issue is rarely the absence of rules. It's the inability to follow the ones they already have. So let me ask you, how many rules do you already know, but don't consistently apply? You know you shouldn't over-leverage. You know you shouldn't chase price. You know you shouldn't enter without confirmation. These aren't secrets. They're basic principles repeated everywhere. Yet in live trading, they're the first things to disappear. Why? Because rules are easy to respect when there's no pressure. The real test comes when money is on the line, when the market is moving quickly, when you feel like you might miss out. In that moment, rules start to feel optional, flexible, adjustable, and that's where mistakes begin. A trader breaks one rule, just once, just this time. Maybe the setup looks too good to miss. Maybe the last trade was a loss, and there's a need to recover. The reasoning feels justified. It always does in the moment. But what happens next? The trade becomes different. It's no longer part of a system. It's now driven by emotion, urgency, frustration, impatience. And once emotion takes control, discipline steps aside. Have you noticed how one broken rule often leads to another? You enter without a proper setup. Then you hold longer than you should. Then you increase risk to compensate. One decision spills into the next. Not because the market forced it, but because your structure is gone. Rules are not there to predict the market. They are there to protect you from yourself. That's their real function. Without rules, every decision becomes negotiable. And when every decision is negotiable, your behavior becomes inconsistent. One day you're disciplined, the next day you're impulsive. The market hasn't changed, but you have. So ask yourself, are your losses coming from the strategy or from the moments you step outside of it? Because those moments are often ignored. Traders review their trades and focus on the outcome, not the process. A losing trade gets labeled as a bad setup, even if it followed the rules perfectly. A winning trade gets praised, even if it broke every rule in place. And that creates a dangerous cycle. You start reinforcing the wrong behavior. You start trusting outcomes instead of discipline. But consistency doesn't come from being right. It comes from being aligned. Aligned with your rules, even when it's uncomfortable, even when it means missing a move, even when it means accepting a loss without trying to interfere. Let's make this practical. A rule might be, I only enter after confirmation. Simple, clear. But in real time, price starts moving before confirmation appears. It looks strong. It feels like it's going to run without you. Now what? Do you wait, or do you jump in early? That decision, right there, is where most mistakes happen. Not because the rule is unclear, but because the temptation is strong. And if you break it, what are you really doing? You're not improving your system. You're weakening it. Because every time you ignore a rule and get away with it, you train yourself to ignore it again. So the issue isn't knowledge, it's consistency under pressure. Rules only work if they are followed when it's hardest to follow them. And that's the part traders underestimate. They design rules in a calm state, but they execute them in an emotional one. And unless those rules are simple, clear, and internalized, they won't hold. So the real question is, are your rules strong enough to guide you when you don't feel like following them? The market rewards discipline, not intelligence. That idea can feel uncomfortable, especially if you've spent time studying, analyzing, and trying to understand every detail of how markets move. Knowledge feels like an advantage. It should be. But in trading, knowledge without control often turns into a liability. Think about it. How many intelligent traders do you know who still struggle to stay consistent? They understand patterns. They can explain market structure. They can even predict moves correctly. But when it comes to execution, something breaks down. They exit too early. They hold too long. They take trades they didn't plan. The problem isn't what they know, it's what they do. So let me ask you, when you're in a trade, is your behavior guided by what you know or by how you feel? Because those two don't always align. Intelligence encourages analysis. It pushes you to interpret, adjust, and refine. But the market doesn't reward constant interpretation. It rewards consistent behavior, and consistency comes from discipline, not intellect. A disciplined trader might have a simple system. Nothing impressive, no deep complexity. But they follow it, again and again, without deviation. They take the same type of trades, manage risk the same way, exit based on predefined conditions. Over time, that repetition builds stability. Now compare that to a highly analytical trader. Every trade is slightly different. Every decision is adjusted based on new information. It feels adaptive, even smart. But it creates inconsistency, and inconsistency makes results unreliable. Have you ever noticed how overthinking often leads to hesitation? You see a setup, but instead of acting, You analyze it further. You look for more confirmation. You question the context. By the time you decide, the opportunity is gone. Or worse, you enter late with reduced confidence. That's not a lack of intelligence. That's a lack of discipline in decision-making. Discipline simplifies action. It reduces the need to think in real time. It creates boundaries. What you will do, what you won't do, and under what conditions. And those boundaries protect you. Because the market constantly tempts you to step outside your plan. It offers new information, sudden moves, unexpected behavior. It invites you to react, and intelligence, if not controlled, will justify that reaction. You see something new, so you adjust. That pattern looks different, so you adapt. It feels like this trade will work, even if it's not part of your system. Each thought sounds reasonable, logical, but together, they pull you away from consistency. So the real question becomes, are you using intelligence to follow your system or to override it? Because there's a difference. Intelligence should build your rules. Discipline should execute them, not the other way around. When discipline is absent, intelligence starts making decisions in real time, and real-time decisions are often influenced by emotion, fear, greed, urgency. You may not notice it, because the reasoning still sounds logical, but underneath, the driver has changed, and that's where mistakes begin. A disciplined trader accepts limitations. They accept that they won't catch every move. They accept that some trades will fail. They don't try to outthink the market. They focus on repeating a process that has an edge. That repetition is what creates long-term results. So let me ask you, would you rather be right occasionally or consistent over time? Because trading doesn't reward moments of brilliance. It rewards steady behavior, and steady behavior comes from discipline, not intelligence, just control. Fewer decisions lead to better execution. It sounds almost counterintuitive, especially in a field where people believe success comes from constant analysis and quick thinking. But if you observe your own trading closely, you'll start to notice something. Most of your worst decisions don't come from lack of opportunity, they come from too many choices. Think about a typical trading session. Charts open, multiple pairs or stocks in front of you, different time frames, different signals forming. Every moment presents a new possibility, and with each possibility comes a decision. Should you enter, wait, exit, adjust, re-enter? Now let me ask you, how many of those decisions actually improve your results? Because every additional decision introduces the chance for error. When you have too many options, your focus spreads thin. You start reacting instead of following a plan. One signal contradicts another, one time frame disagrees with the next, and suddenly you're no longer executing. You're negotiating with the market. That negotiation creates hesitation, and hesitation disrupts timing. Execution in trading is not just about what you do, but when you do it. A good idea executed late often becomes a bad trade. A valid setup missed due to overthinking is still a missed opportunity. So what causes that delay? Too many decisions. When your process is simple, your actions become automatic. You recognize your setup, you know your conditions, and you act. There's no internal debate, no need to weigh multiple scenarios in real time. But when your approach is overloaded, every trade becomes a discussion. You start asking yourself, should I wait for more confirmation? Should I reduce size? Should I check another indicator? And while you're deciding, the market moves. Have you ever missed a clean setup because you were still thinking about it? Or entered late because you needed one more piece of confirmation? That's not lack of skill, that's decision overload. Now consider the effect of reducing decisions. If you limit what you trade, when you trade, and how you trade, something changes. Your environment becomes quieter. You're no longer scanning everything, you're waiting for specific conditions, and waiting is powerful. It filters out noise. It removes unnecessary action. It keeps you aligned with your plan. A trader who makes fewer decisions isn't less active. They're more selective. They've already decided in advance what matters and what doesn't. So when the moment comes, they don't need to think. They just execute. That's where consistency begins. Because consistency doesn't come from making better decisions every time. It comes from reducing the number of decisions that need to be made. Let's make this practical. Instead of watching 10 markets, you watch 2. Instead of trading all day, you focus on a specific session. Instead of taking every setup, you define 1 or 2 that meet your criteria. What happens then? Your attention sharpens, your confidence increases, and your execution becomes cleaner. But here's the challenge. Doing less feels like missing out. The market is always moving. Opportunities are always appearing, and the urge to participate is constant. Reducing decisions means saying no more often than you say yes. So ask yourself, are you trading every opportunity or only the right ones? Because more trades don't equal better results. More decisions don't equal more control. In fact, it's usually the opposite. The traders who struggle the most are often the ones doing the most, analyzing more, trading more, adjusting more. And in that constant activity, clarity gets lost. Fewer decisions create space, space to observe, space to act with intention, space to stay disciplined. And when that space is present, execution becomes simpler, not easier, but clearer. You see what matters, you ignore what doesn't, and you act without hesitation. Less noise, better timing, cleaner trades, fewer decisions. What you avoid trading matters more than what you trade. That idea doesn't get much attention because most traders are focused on finding opportunities, not filtering them. The mindset is always about entry, where to get in, how to catch the move, how not to miss out. But think about it. How many of your losses come from trades you had to take, and how many come from trades you could have easily ignored? Because the market is always offering something. Movement, volatility, setups that look almost right. And almost right is where most mistakes live. So let me ask you, do you have clear rules for what to avoid, or are you only focused on what to take? Avoidance requires discipline. It means sitting still while the market moves. It means watching opportunities pass without acting. And that's uncomfortable because it feels like you're missing something. But missing a bad trade is not a loss, it's protection. The problem is, bad trades rarely look bad at the start. They look tempting. They look close enough. Maybe the trend is unclear, but there's momentum. Maybe the level isn't clean, but it's good enough. Maybe the setup doesn't fully match your plan, but it feels like it could work. And that's where traders step in. Not because the setup is strong, but because it's available. Have you noticed how easy it is to convince yourself when you want to be in the market? You start adjusting your standards. What was once a clear rule becomes flexible. You widen your criteria just enough to justify the trade. And in doing so, you lower the quality of your decisions. Now consider the opposite approach. Instead of asking, is this a trade I can take? You ask, is there any reason I should avoid this? That shift changes everything. It forces you to look for weaknesses instead of strengths. It puts your focus on risk, not just opportunity. And often you'll find that the reasons to stay out are clearer than the reasons to get in. A messy structure, a choppy range, conflicting signals, low volume, unclear direction. Individually, each might seem manageable, but together they create uncertainty. And uncertainty is where inconsistency grows. So the real question is, are you filtering trades strictly enough, or are you allowing borderline setups to pass? Because every trade you take has a cost. Not just financially, but mentally. A poor trade affects your confidence. It influences your next decision. It creates noise in your process. Avoiding that trade doesn't just save money, it preserves clarity. Let's make this practical. A simple avoidance rule might be, I don't trade in choppy markets. Sounds straightforward. But in real time, price starts moving within that chop. Small breakouts, quick reversals. It looks active. It feels like opportunity. Now what? Do you stick to your rule or do you engage? Most traders engage. They get pulled into the movement, only to get caught in the noise. Multiple small losses, frustration building, confidence dropping. Not because the market was unpredictable, but because the environment was unsuitable. Avoidance would have solved that. Another example, trading against the higher time frame trend. You see a short-term setup forming, but the larger direction is clear. Do you take the counter trade or do you stand aside? That decision, what you choose not to trade, often has more impact than the trades you do take, because consistency isn't built on catching every move. It's built on selecting the right conditions, and selection is mostly about exclusion. So ask yourself, are you protecting your capital by avoiding weak setups, or are you exposing it by participating in everything that moves? Because the market doesn't reward activity, it rewards precision. And precision comes from restraint. Not every move is yours. Not every setup deserves your attention. Sometimes the best trade is no trade. Consistency in rules creates clarity in results.